Hello, everyone, and thank you very much for joining us for this week's Nasdaq Dorsey Wright podcast for August 19th. My name is Ian Saunders, and joining us this week is Sara Maley. And Sara, we're coming in this week to new all-time highs for the S&P 500, at least on an intraday basis. We're taking a look at the chart page of the S&P 500, and in order to widen that chart scale out a little bit to see some of the more historical movement that we've seen the more volatile movement that we've had this year, you can widen that chart page out to get to a 30-point per box size chart. And in doing so, we can see that the S&P 500 printed in to match its all-time high on this chart, on the 30-point chart at 33.90 there yesterday, with an additional X printed. So seeing a fair amount of follow through across the board on the domestic equity perspective. Looking now at the index, it's given two consecutive buy signals. It's moved back to a positive trend on this more longer intermediate term chart back in May and has continued largely higher there since. Completed a bullish triangle formation there in July and continuing higher here in August. So definitely seeing some continued positive improvement there, at least for the broader, larger cap space on the domestic equity side. And in looking at this chart, we're looking at looking at the 10-point chart, we can see that the index got pretty close with movement this morning to printing a new all-time high on that 10-point default chart. And since backed off a little bit from that, we'll see where we close this afternoon. But definitely one point that we're continuing to look out for to see if we can break through that 33.90 level to get to that 3400 point to print that new all-time high on the default chart. And another point that we're continuing to monitor there is the overbought oversold percentage for the broader index. On the chart page, you can see the weekly OBOS percentage in the upper right-hand corner, which, for those of you who are following along, is going to correspond to essentially where the last trade from close yesterday, or close from the prior market day, sits relative to its 10-week trailing trading band. So we have a 10-week trailing trading band that's going to be depicted on the right-hand side of the point figure charts there on the research platform. And we've seen the S&P 500 continue to climb back up towards more elevated trading territory at a weekly OBOS reading through Trading Tuesday of 67%. Typically, we're going to be looking at the 70% level as really a line of demarcation to identify positions that might be more overextended. And so we're certainly creeping back up towards that direction there for at least this broad market benchmark representative there. But for those who are looking to follow it on an intraday basis, I did want to highlight a new point that you can utilize there on the platform. If you click on that weekly OBOS reading, it will actually bring up an intraday reading, along with the historical readings that you can see there depicted on the pop-up page. So when you're looking there at that page, you can see the historical readings on a week-by-week basis continue to climb back up really since the end of June. Throughout July, continue to head more towards the overbought side, and now with an intraday weekly OBOS percentage of 68%. So seeing the minimal gains that we're looking at the time of this recording this afternoon, not changing the overbought oversold percentage all too much, but definitely could be one point to monitor if we do get some major movement either for the index or for an individual name. Can be pretty helpful to come in and see how that's going to affect that weekly OBOS reading on an intraday basis. So a couple points there that we're continuing to look at. And when we're looking at the broad market index here in and of itself, I mean, it's been hard to ignore those large cap names that have really carried, especially this index, higher. I mean, we're looking at a very focused top end of the S&P 500, at least from an allocation perspective, with those real mega cap names really being the big bellwether areas that have continued to lead the market through the most recent rally that we've seen. And there's a couple different ways that you can look to play those more focused mega cap areas. One specifically there, Sara, that you were showing me earlier was the chart of XLG.
Yeah, so one of those funds is the Invesco Sp 500 Top 50 ETF Xlg. And what this is owning is just those top 50 mega cap, large cap names in the S&P 500 index, which we've seen, as Ian said, drive these indexes higher. In fact, the top five, or the big five as they're calling them now, are make up 25% of the S&P 500. So when we look at the XLG, so on the S&P 500 index, we kind of slowed down the time frame to take a step out. But for charts like this, for XLG, we actually want to zoom in and make that chart movement a little more, we want to see more chart action. Because if you notice here, right now with levels that we're at 260, initial support isn't down into that 188 level. So that's about 28% away off of where we're trading right now, which, if you're looking for either ways to get into this name or if you need to adjust your stops, 28% is not really that helpful. So what we can do is we can click on that 2 on the left-hand side under other scales. And so this drops it down, the box size, from 5, which is the default chart there, down to 2. And so when we make the chart movement more sensitive, as you can see, it speeds up that action. So this chart has given, I believe, 8 consecutive buy signals. It also completed a bullish triangle, it looks like, before giving 2 consecutive double tops just last month. And you can see also that GreenX tells us that yesterday this fund was able to print a new all-time high at 264. And so here we're able to, adjust those support levels. If you were looking to get in here, as Ian said, that 70% line is our overbought line of demarcation. We're right at 70% here. So you could either look to scale in here or wait for a potential pullback. Initial support is at 246 with additional support at 244. So with those large mega cap names, a lot of these charts are up on stems. QQQ is another example. That particular chart is about 34.5% away from its initial support. Both of these charts, the XLG and QQQ, have started those columns of X's in April. So they've been intact for, over 4 months now, with 0 reversals down into O's. So it's a great way, again, to adjust your stops or just get a little better entry points. And so while we've seen these large cap and mega cap names drive higher, we've also seen that reflected in our DALI, dynamic asset level investing tool, our asset allocation tool. So we saw U.S. equities move up into the number 2 spot. It remains second. It trails fixed income. But what we can see using the DALI history is that spread between number 1 and number 2 is narrowing. So while we saw, the signal count, well above, 50-point spreads going back over the last few months, we've seen that spread narrow down to just 5 signals. So if U.S. equities are able to continue to rally, if fixed income either stays steady or experiences a pullback, we can see those charts start to adjust. It's all relative, so it could be a combination of things, but we have seen that gap at least narrow to 5. So this is something to watch. Be sure to set your DALI alerts so that if there is a change that you will receive an email, and you can do that by clicking on the Set Alerts button in the top right-hand corner.
Absolutely. And Sarah there mentioned, I think this page, the historical perspective, well, it's great to look at the general overview there for the DALI tool. Coming in, and it's been one question we've gotten a fair amount recently. Well, the markets are hitting new all-time highs. Why is domestic equity still number 2, right? And coming in here and looking at this historical perspective, you can really see exactly like you said that domestic equities has been steadily rising from a buy signal perspective since reaching that low of 159. And fixed income has been steadily decreasing. So, they're certainly heading towards a convergent point. We'll definitely be sure to keep an eye on this for further follow through the upside there in the case of domestic equities. One thing to keep in mind is we do want to look for that 5 signal differential for domestic equities to be 5 signals ahead of fixed income before we're going to truly cement that change number 1 if it does occur. But just definitely another point to keep in mind there. And as Sarah said, set alerts on this ranking. Another ranking that you can come in and take a look at here on the DALI page, you can find under the details button. And the details button is going to provide you with that 6 broad asset class ranking like you'll come to know and love there on the DALI overview, the general page. But you can get at some more in-depth levels of readings. They're going to be housed on this page, 2 of which specifically pertain to the strength of the asset classes against cash. So if we think of that buy signal perspective as that big picture, long-term, longest-term view of strength, the cash percent rank is another one that we can look at for a little bit more intermediate-term perspective, which essentially is going to be taking a matrix of domestic equity representatives and ranking them, and then throwing cash into that matrix as well to see, Okay, well, where does cash fall on our matrix of domestic equity names? Looking at broad representation within that matrix. And then what the cash percent rank on this page is going to depict is going to be essentially the percentage of names that cash is beating. So currently, we can see that that reading comes up at a 9.09%, which is telling us that cash, our cash proxy in that matrix is only beating 9% of the domestic equity representatives. This indicator functions in thirds. It looks at if we see cash dropped into the bottom third, then that's going to give you a green, strong reading for the asset class against cash. If it's in the middle third from 33 to 66, you'll get an average yellow reading. And if it's in the top third above 66%, you'll get a red, weak reading. We saw this reading climb as high as 98% in March. So it has certainly fallen significantly to bring it down to its current level there of 9%, marking the first time it dropped down beneath that 10% threshold since the volatility ensued there in March. So another point that you can kind of continue to monitor there for that a little more intermediate term basis in that broad asset class rank. And in thinking of it in a similar vein, another percentage-based indicator we have on the research platform is something that you can find on the asset class group scores page. This page is going to be a little bit different than the strictly relative strength-based Valley tool, looking at averaging fund scores together to get a ranking of essentially each of your investable areas around the market. 135 different groups that we're going to classify funds in here too, all ranked by their average score. And one of those groups that we look towards is the U.S. money market group, which we can see as a current ranking of 126th out of the 135. One of the readings we track for this group is what we call the money market percent rank, which basically tracks in a similar vein to that cash percent rank, what percentage of groups here on this page, in this case, is that money market group beating. We can see this reading drop down to 6.34% over the past week, again, marking the first time it's fallen beneath that 10% threshold over the past week here since the volatility picked up there in March. So a further indication, further positive sign for really the global equity space is it hasn't just been U.S. equities that have been dampening this money market score. We're seeing the emerging markets diversified group on this page move back above the 4-score threshold into what we call the blue sky territory, the favorable group zone, with movement there yesterday. Some other areas, looking at commodities continuing to climb higher from a score perspective. So a wide variety of names that we're seeing continue to score higher, and that's all leading to a continued dampening score there for the U.S. money market. So another place you can come to look at some more day-to-day, week-to-week movements, because those scores are going to change just about every day. Now, they might change significantly. They might change very little. But one place you can definitely be sure to keep an eye on there, and you can set alerts on the right-hand side of this asset class group scores page if that's something you wanted to be notified of further movement from there. So a couple different areas that we can continue to look towards, at least as we wrap up the summer months of the year here, Sarah. I know things are a little bit quieter with a lot of people seemingly being out on vacation or hopefully spending time with their families here this week. So we'll keep it brief here with our update this week. I think we pretty much touched on everything we were looking to cover there, Sarah.
Yeah, my only thing is just, if you're able to join the weekly beginner series on Fridays, we probably suggest joining those just to learn some, just some basics directly from the analysts, and also joining us for our Monday market webinars, which we've been hosting over the last few months now. All that registration information and replays, it's all available in the daily equity report. But that's all that I have.
Yeah, and so, if you have any questions on that or where to find any of that, we're the analyst team, for those of you that are subscribers, are always more than happy to take any questions or anything that you have, either by phone or by email. So you can reach out to us by phone there at 804-320-8511, or by email at dwa@DorseyWright.com. So with that, I want to thank everyone very much for joining us here this week, and we look forward to having you back next week.